Hey everyone, and welcome to This Explainer. Today, we're unpacking a really fascinating shift that's happening right before our eyes in the energy sector. We're going to look at how traditional energy giants are completely pivoting, like right now, in real time, to meet the massive industrialized power demands of our modern world. Specifically, we're diving into Baker Hughes and their Q2 2026 earnings results. This just isn't about traditional oil and gas anymore. It's about the literal infrastructure required to power our future. So let's jump right in.
I want to start right here. $10.5 billion. Yeah, you heard that right. That is the total order number Baker Hughes booked in just the second quarter alone. It's an absolutely staggering figure, and it immediately shows us some undeniable market momentum. I mean, when you see a number like this, it tells you for sure that a company has fundamentally aligned itself with what the market is aggressively buying right now.
And to put that into perspective, the CEO, Lorenzo Simonelli, summed it up perfectly. He said, Baker Hughes delivered another strong quarter, reflecting the breadth of our portfolio and continued momentum across data center, gas infrastructure, and upstream markets. Notice what he literally mentions first there? Data centers. This isn't an accident. This success is a deliberate strategic pivot. They're actively rewriting their own energy equation to capture the massive momentum in new infrastructure, all while keeping their core upstream markets strong.
Okay, so here's our roadmap for this explainer. 1. The new energy equation. 2. Record Q2 financials. 3. IET, powering the future. 4. OFSE, resilient core operations. And 5. The chart industries era.
Let's move straight into Section 1, the new energy equation. We're talking AI, data centers, and the global power thirst. So, the entire energy market right now is basically framed by three core pillars. First, you've got upstream, where customers are laser-focused on optimizing the assets they already have. Second is LNG, which is really all about global supply security, and that's driving toward a massive 800 million tons per annum by 2030. But the third pillar? Well, that's where the true explosive growth is happening: power. We are seeing a fundamental step change in power demand, and it's being driven directly by AI and massive compute workloads. To give you an idea, data center power demand alone is projected to grow at roughly 18% every single year through the end of the decade. This energy infrastructure is literally the backbone of the AI revolution. And because of that 18% annual growth in data center demand we were just talking about, Baker Hughes is looking at a nearly $100 billion annual addressable market for power systems by 2030. The AI hyperscalers are creating this insatiable thirst for electricity, and traditional grids simply cannot handle it without massive upgrades and entirely new distributed power generation.
Right, moving to Section 2, record Q2 financials. Let's see how they're translating this strategy into hard numbers. These Q2 consolidated results are honestly a masterclass in disciplined execution. Just look at those orders, up a massive 49% year over year to that $10.5 billion figure we opened with. Now, revenue is actually down slightly by 2% because of some planned business exits, but check out the line right below that. Adjusted EBITDA is up 2% to $1.23 billion. That actually beat the high end of their own guidance. And their free cash flow, it more than doubled, hitting $1.1 billion. So the takeaway here is absolutely crucial. They aren't just selling more stuff, they are operating fundamentally better.
You can actually see that operational excellence clearly in their adjusted EBITDA margin, which expanded 70 basis points year over year to a record 18.3%. Now, in the industrial services sector, fighting inflation and supply chain bottlenecks to wring out nearly a full percentage point of margin expansion, that's incredibly difficult. It's absolute proof that their internal cost-cutting initiatives and pricing strategies are just working perfectly.
Which brings us to the absolute star of the quarter. Section 3, IET, powering the future. This is their industrial and energy technology segment, and it's totally leading the charge.
The true growth engine of Baker Hughes right now is sitting right here in these performance metrics. IET orders didn't just grow, they literally doubled, up over 100% year over year, hitting $7.08 billion. While revenue was flat, again, mostly due to those planned business exits we mentioned, EBITDA jumped 16%. They're building a massive, highly profitable backlog in this specific segment. And where exactly are those orders coming from? Look at these multi-gigawatt awards. I mean, they secured a 1.3 gigawatt order from Dynamis for mobile power, specifically targeting data centers and oil and gas. They signed an initial 1 gigawatt power generation award with Kodiak Gas Services. And you can add to that massive LNG infrastructure wins with Venture Global and Golar. These are not minor equipment sales, right? These are foundational energy infrastructure contracts that directly feed the macro power thirst we outlined at the very start of this explainer.
And we can see their technology actively adapting to new markets too. For example, they just had the first deployment of their Lucipa digital optimization software entirely outside of the oil and gas sector. It's actually being used for a geothermal and lithium extraction development over in Europe. On top of that, they just announced a big collaboration with Mantle Reach Power for a 500-megawatt geothermal development in North America. They're actively stretching their digital and subsurface expertise into the broader energy transition.
But of course, we definitely can't ignore the historical core of the company. Section 4, OFSE, Resilient Core Operations. That stands for Oil Field Services and Equipment, and it's all about finding strength in complex environments.
Despite some really significant geopolitical and operational complexities in the Middle East lately, the durability shown in these sequential metrics is remarkable. Compared to the first quarter of this year, OFSE grew across the board. Orders were up 4%, revenue was up 7%, and EBITDA was up 7%, coming in at $605 million. This segment actually beat the high end of management's guidance, even with all those regional headwinds.
So the secret sauce here is international diversity. Because they're a truly global operation, they can offset weakness in one region with wins in another. Just look at this geographic spread. You've got major well construction in Brazil for Petrobras, drilling extensions in Norway with Equinor, ultra-deep water subsea systems in Angola, and offshore integrated systems in Brunei. This global footprint is exactly what gives them that rock-solid financial resilience.
These complex offshore operations are the perfect reminder that optimizing traditional production remains a highly profitable, deeply technical foundation for Baker Hughes. While the new energy transition gets a ton of the headlines, successfully navigating and executing in these harsh offshore environments provides the reliable cash flow that actually allows the company to invest so aggressively in its future.
Which leads us perfectly into our final section, Section 5, the Chart Industries Era, Advancing Strategic Transformation.
Okay, so on July 16th, Baker Hughes officially completed the acquisition of Chart Industries. This is a massive portfolio shift, and management has laid out a highly disciplined integration roadmap to make it happen. Day 1 is all about aligning operating models. By day 90, they're focused on maintaining customer continuity while launching some early synergy actions. And then, by 180 days, they plan to start piloting fully integrated customer solutions. Management clearly knows exactly how they want to securely weave these two massive entities together.
And the expected run rate cost synergies? They present an incredibly compelling financial rationale. By the end of year 1, they're expecting $95 million in savings. Year 2, that jumps up to $230 million. And by year 3, they expect $325 million in compounding financial value just from things like supply chain efficiencies, facility optimization, and reducing duplicative costs. That is pure value dropping straight to the bottom line.
But here's the thing, it's not just about cost-cutting, it's about commercial acceleration. Chart brings highly complementary technologies in thermal management and carbon capture. It dramatically expands Baker Hughes's presence in geothermal and broader energy infrastructure. But most importantly, it creates a much larger installed equipment base. And that means a massive runway for recurring, high-margin aftermarket and digital lifecycle services all over the globe.
Which brings us to the climax number of the day, $45 billion. Because of the record IET bookings we discussed, the robust pipeline across industrial markets, and the sheer confidence in their strategic expansion, management just raised their Horizon 2 IET order target, which covers 2026 to 2028, from $40 billion to over $45 billion. This is the ultimate signal of executive confidence in this huge strategic pivot.
We've just walked through a masterclass on how a legacy energy services company is transforming itself into a much broader, industrialized energy solutions provider. As AI, data centers, and global infrastructure demand exponentially more power, the very definition of an energy company is fundamentally changing. So the question I want to leave you with today is this. Based on this blueprint from Baker Hughes, how will the rest of the traditional energy sector evolve to meet the staggering industrialized energy demands of tomorrow? Thank you so much for joining this explainer, and keep learning.